Friday. That's the day everything changes for silver. I'm not talking about a gradual price increase or a normal market move. I'm talking about a complete reset of silver's value that could send prices from today as $25 to as high as $300 per ounce. And the mechanism that's going to trigger this is already in motion and cannot be stopped. If you don't own physical silver before Friday, you could miss the single greatest wealth building opportunity of your lifetime. This is not hyperbole. This is not clickbait. This is mathematical reality based on supply and demand fundamentals that are about to collide in a way that will shock the financial world. Stay with me, because what I am about to explain will either make you very wealthy or leave you watching in regret as others capture generational wealth while you stood on the sidelines. Welcome to George Vance Live, where we reveal the market dynamics that could change your financial future forever. If you're new here, you need to subscribe immediately and turn on all notifications. Because by Friday, the information in this video could be worth more money than you've made in the past year, but only if you understand it and act before the window closes. Let me start by explaining exactly what is happening on Friday and why this specific date is so critical. Friday marks the final settlement date for a convergence of events that have been building for months. First, it's the last day of the month, which means month-end rebalancing for major funds and institutions. Second, it's the options expiration for March contracts, which includes massive open interest in silver call options. Third, and most importantly, it's the deadline for several large industrial users to secure physical silver delivery for Q2 production needs. And the contracts they're trying to fill represent more silver than currently exists in available inventories. Here's where it gets explosive. The total open interest in silver derivatives, futures, and options represents over 3 billion ounces of silver. That's not a typo, 3 billion ounces. Meanwhile, the actual physical silver available for delivery in exchange warehouses is less than 300 million ounces. That's a 10-to-1 ratio of paper claims to physical metal. It's the biggest disconnect between paper and physical in any commodity market in modern history. When the industrial users demand delivery on Friday and the silver isn't there, the entire paper pricing scheme collapses, and price has to reset to a level that reflects actual scarcity. Now, let me walk you through the mathematics of why $300 per ounce is not only possible, but conservative, given the supply-demand dynamics. Global silver mine production is approximately 830 million ounces per year. Industrial consumption alone is over 600 million ounces and growing at 8% annually. Investment demand adds another 250 million ounces. That's 850 million ounces of demand against 830 million ounces of supply, creating a 20 million ounce deficit even before you account for any supply disruptions or demand spikes. But here's what makes this explosive. Above-ground silver inventories that are actually available for sale have been declining for years. Most silver is either in jewelry, silverware, or industrial products, where it's consumed and not recoverable at any reasonable cost. The silver that's in vaults and available is estimated at around 2 billion ounces globally. But the vast majority of that is in private hands or sovereign reserves and is not for sale at current prices. The actual liquid supply that trades is probably closer to 500 million ounces. When you have industrial demand alone at 600 million ounces per year and liquid supply at 500 million, the math doesn't work unless prices rise dramatically. Here's the calculation that gets you to $300. If silver needs to rise to a price level that both reduces industrial consumption through substitution and attracts enough recycling and private selling to balance the market, historical precedents suggest that requires at least a tenfold increase from artificially suppressed levels. Silver, at $25, is provably below the cost of production for a significant portion of mines when you include full cycle costs. Many primary silver miners are losing money at current prices. The true equilibrium price that sustains production and balances industrial demand is estimated by independent analysts at between $150 and $200. But in a shortage crisis where industrial users absolutely need the metal for production and will pay whatever it takes, prices can spike well beyond equilibrium. We saw copper briefly hit $11 per pound in 2022 when shortages developed, triple its normal range. We saw palladium hit $3,000 when the auto industry needed it for catalytic converters and supply tightened. Silver, at $300, represents roughly a 12 times increase, which is actually less than palladium's move in percentage terms. Given silver's superior fundamentals and the magnitude of the paper to physical disconnect, $300 is achievable in a genuine shortage scenario. Let me show you the evidence that this shortage is real and the Friday deadline is legitimate. First, look at what's happening in the physical market right now. Premiums on silver coins and bars have exploded to $6 to $8 over spot price, representing 25 to 30% markups. Delivery times from major dealers have stretched to 6 to 8 weeks for many products. Some popular items like Silver Eagles or certain bars are completely sold out with no estimated restock dates. This is the physical market screaming that there's not enough silver available at current prices. Second, examine the COMEX warehouse data. Registered silver, which is the category available for delivery against futures contracts, has dropped from over 100 million ounces a few years ago to around 40 million ounces today. Eligible silver, which is being stored but not available for delivery, has increased, but that just shows that silver owners are choosing not to make their metal available at current prices. The shrinking registered category relative to open interest is a classic setup for a delivery squeeze. Third, look at the industrial user behavior. Multiple reports have emerged of solar panel manufacturers, electronics companies, and other industrial users scrambling to secure physical silver supplies. Some are paying premiums of 20 to 30% over spot price for guaranteed delivery. Some are buying directly from mines at above market prices with long-term contracts. This is panic buying behavior from sophisticated industrial users who know that if they can't secure silver, their production lines shut down. They're not worried about whether silver costs $25 or $30 or $40. They're worried about getting the metal at all. Fourth, examine the mining sector. Major silver producers like First Majestic have announced they're reducing or eliminating their hedging programs, meaning they're betting on higher prices and want full exposure to the upside. Exploration budgets are being increased. Merger and acquisition activity in the sector has accelerated as larger miners try to secure reserves. This is textbook behavior when an industry expects significant price appreciation. Miners with access to the best data about supply and demand are positioning for a bull market. Fifth, consider the monetary and geopolitical factors. Central banks globally have been buying gold at record rates, but several emerging market central banks have also been accumulating silver. Why? Because in a currency crisis or de-dollarization scenario, both gold and silver serve as monetary metals and stores of value. If confidence in fiat currencies deteriorates further, investment demand for silver could surge from current levels of 250 million ounces to 500 million or more. That alone would create an acute shortage at current production levels. Now, let me explain the specific catalysts converging on Friday that make this the trigger date. The March options expiration includes enormous open interest in call options, with strike prices between $30 and $50. If silver starts rising and approaches those strikes, the dealers who sold those options have to buy physical or futures to hedge their positions. This creates a gamma squeeze where rising prices force buying, which drives prices higher, which forces more buying. It's a self-reinforcing loop that can send prices vertical in a short time. The month end. Rebalancing by commodity funds and ETFs means they have to true up their positions to match their mandate allocations. If silver has moved significantly during the month, this can force large buy or sell orders at month end. Given the supply tightness, any significant buying pressure could be the spark that ignites the squeeze. The industrial delivery contracts settling Friday represent real-world demand for physical metal that cannot be settled in cash or rolled forward. These are manufacturers who need actual silver in hand to maintain production. If the silver to satisfy those contracts isn't available, they'll bid up the price to whatever level attracts supply. When you combine these three factors all hitting on the same day, you create what's called a reflexive feedback loop. Options dealers hedging drives the price up. Rising prices trigger month-end buying. Month-end buying tightens available supply for industrial delivery. Industrial users bid more aggressively. Higher bids attract momentum traders and investors. All of this compounds on itself, and in a market as relatively small as silver, where the entire above-ground supply is worth maybe $50 billion, it doesn't take massive capital inflows to move the price dramatically. A few $1 billion flooding into silver in a short time frame could easily double or triple the price. Let me paint you a picture of what Friday and the following week could look like if this plays out. Markets open Friday morning and silver is trading around $25. By mid-morning, as options dealers start hedging their gamma exposure and industrial buyers place large orders, silver jumps to $28. The move accelerates through $30 by early afternoon as momentum algorithms kick in and retail traders pile in. Silver closes Friday at $35, a 40% gain in one day, and that's just the beginning. Over the weekend, social media explodes with silver squeeze content. Retail investors around the world try to buy physical, but find that dealers are sold out or premiums have doubled overnight. By Monday morning, silver gaps open at $45. The scramble for physical intensifies. Industrial users who thought they could wait are now panicking and bidding aggressively. Silver mining stocks are up 50 to 100%. By midweek, silver hits $75 and some analysts are calling for 100 plus. The mainstream media finally covers the story, bringing in another wave of buyers. Within a month, as the reality of the shortage becomes undeniable and as investment demand surges globally, silver could realistically be trading between $150 and $300. Mining stocks that were $10 are now $50 or $100. Junior miners have gone up 5 to 10 times. People who bought physical silver at $25 have multiplied their money by 6 to 12 times. Those who waited or didn't believe it could happen are trying to buy at $150 and kicking themselves for missing the opportunity when it was obvious. Now let me tell you exactly how to position yourself before Friday to maximize your gains from this reset. Time is absolutely critical because the window is closing by the hour. First and most important, you need to own physical silver. Not paper silver, not ETFs, actual coins or bars that you possess. Go to a reputable dealer today, right now, and buy whatever physical silver you can get your hands on at current prices. Don't wait for a dip. Don't wait for confirmation. Every hour you delay, premiums are going up and availability is declining. Buy Silver Eagles, Silver Maple Leafs, or bars from recognized refiners like Sunshine Mint, APMEX, or Royal Canadian Mint. Expect to pay $6 to $8 premiums over spot. And understand that by Friday, those premiums could be $15 to $20 if the squeeze accelerates. Pay the premium. Lock in your physical metal now. The difference between a $6 and a $15 premium is meaningless if silver goes to $100 or $200 or $300. What matters is securing the physical metal before it's unavailable at any price. How much should you buy? As much as you can reasonably afford without jeopardizing your ability to pay bills or handle emergencies. If you can allocate 10% of your liquid net worth to physical silver right now, do it. If you can do 20%, even better. This is potentially a once-in-a-generation opportunity, and the upside vastly outweighs the downside. Even if I'm wrong and silver only goes to $40 or $50 instead of $300, you've still doubled your money. But if I'm right, you've changed your family's financial future forever. Second, if you can't get physical or you want additional exposure beyond what you can physically hold, buy silver ETFs, but understand the risks. SLV and PSLV are the two main options. PSLV is generally considered superior because it's fully allocated and you can redeem for physical if you have enough shares. SLV has ongoing questions about whether it actually holds all the silver it claims. In a genuine shortage crisis, there's uncertainty about whether ETF holders will be able to redeem for physical or will be forced to accept cash settlement. That said, ETFs will give you price exposure and are better than nothing if physical isn't available. Third, buy silver mining stocks for maximum leverage to the silver price move. When silver doubles, mining stocks can easily triple or quadruple because of operational leverage. A company producing silver at $15, cost that sells at $25, has a $10 margin. If silver goes to $50, they're now making $35 margin, more than tripling their profit. That flows to the stock price. Focus on quality producers with operating mines and strong balance sheets. First Majestic Silver, Hecla Mining, Core Mining, Pan American Silver. These are established companies that will surge with silver prices. Wheaton Precious Metals and Franco-Nevada are royalty companies that provide leveraged exposure with less operational risk. They have agreements to buy silver at fixed prices from operating mines. So when silver prices rise, their profit margins explode without the risk of mining operations. For aggressive investors, junior miners like Silvercrest Metals, Endeavor Silver, or exploration companies can deliver 5 to 10 times returns if silver enters a genuine bull market. But individual company risk is high, so diversify across multiple names. Fourth, for sophisticated traders who understand options, this is one of the best risk-reward setups for call options I've seen in years. Buying call options on SLV or on mining stocks with strike prices between $30 and $50, expiring in April or May, could deliver explosive returns. If silver runs to 100 or higher, those options could be worth 10 to 50 times what you pay for them today. But understand that options can expire worthless if the move doesn't materialize or takes longer than expected. Only use money you can afford to lose completely, and only if you truly understand options mechanics. Now let me address the obvious objections and risks, because I want you making informed decisions. First objection, silver has been predicted to explode for years and it hasn't happened. Why is this time different? Fair question. The answer is the convergence of specific catalysts on a specific date. Past predictions were based on general fundamentals. This is based on concrete delivery demands, options expiration, and industrial buying all hitting simultaneously on Friday. The setup is unique and time-specific. Second objection. If this were real, wouldn't everyone be talking about it? The silence is actually evidence supporting the thesis. Major institutions and industrial users do not want retail buyers competing for scarce supply and driving up prices before they secure what they need. They have every incentive to keep this quiet until after they've positioned. By the time mainstream media covers it, the easy gains will already have been made. You're getting this information before the crowd because you're watching independent sources like this channel instead of waiting for CNBC. Third objection, $300 is too extreme. Silver has never been that high. Actually, inflation adjusted, silver hit the equivalent of over $100 in 1980, And that was in a world with much lower industrial demand. Today's industrial consumption is multiple times higher while supply is constrained. $300 in nominal terms could be conservative if you adjust for currency debasement and the genuine shortage that's developing. Do not let normalcy bias prevent you from seeing what's possible when supply and demand fundamentals break down. Fourth risk, what if the COMEX changes the rules to prevent the squeeze? This is a real risk. Exchanges have modified margin requirements, position limits, and settlement procedures in the past when facing delivery crises. They could force cash settlement, halt trading, or implement other measures to protect the shorts. However, if they do that, it only confirms the shortage and likely accelerates buying in physical and mining stocks, even as futures markets are manipulated. You're protected if you own physical and miners, because those can't be cash settled or manipulated away. Fifth risk, what if industrial users have already secured supply and Friday isn't the crisis I'm describing? It's possible, but the physical market evidence suggests otherwise. Premiums are elevated. Delivery delays are extending. Dealers are out of stock. Well, these are symptoms of shortage, not abundant supply. If industrial users had already secured everything they need, we wouldn't see panic buying behavior in the physical market. The scramble is real, and it's intensifying as Friday approaches. Given these risks, here's how I'd recommend structuring your positioning. Put the majority of your silver allocation into physical metal that you take possession of. This is your insurance policy and your core position. Even if everything else goes wrong, you own real metal that has intrinsic value. Put a smaller portion into quality mining stocks that you can hold for months or years if needed. These give you leverage, but can be held through volatility. Put an even smaller portion into silver ETFs for liquidity and tactical trading. Only put a tiny speculative portion into options, and only if you understand them completely. A sample allocation might look like this: 60% physical silver, 25% mining stocks, 10% ETFs, 5% options. This gives you heavy exposure to the upside while protecting your downside through physical ownership. Adjust based on your risk tolerance, but the principle is to emphasize physical and real assets over paper instruments that could be manipulated or settled in cash. Let me also give you some practical execution advice. If you're buying physical today or tomorrow, call multiple dealers to compare prices and availability. Some will have better premiums or stock than others. Ask about delivery times explicitly. If they say 8 weeks, that's too late for this immediate opportunity. Find dealers who can ship within days. Be prepared to pay by wire transfer or check, because credit cards often have limits and higher fees. Verify the dealer's reputation through reviews and industry associations before sending money. When your silver arrives, store it securely. A home safe bolted to the floor is good for moderate amounts. For larger holdings, consider allocated storage at a professional vault like Brink's or a private facility. Don't tell people you have it. Physical precious metals should be kept private for security reasons. Keep records of your purchases, including receipts and photos for insurance and tax purposes. Treat this as the serious wealth preservation and growth asset it is. For mining stocks, use limit orders rather than market orders to avoid getting filled at terrible prices if there's volatility. Scale into positions over today and tomorrow rather than buying everything at once. This reduces your timing risk. Set alerts on your positions so you know if there are major moves. Have a plan for when you'll take profits. Maybe you sell 25% at a double, another 25% at a triple, and let the rest ride. Having a plan prevents emotional decision-making in the heat of the moment. Now let me share what I'm personally doing based on this analysis. I've been accumulating physical silver for months, but I'm adding to my position significantly this week. I'm buying additional coins from dealers who still have inventory with reasonable delivery times. I'm also adding to my positions in First Majestic Silver and Wheaton precious metals, both of which I believe will multiply if silver enters the bull market I'm anticipating. I'm placing small speculative bets on call options with April expirations because the risk reward is too compelling to ignore. I'm also preparing mentally for the possibility that I'm wrong or the timing is off. If Friday comes and goes without a price explosion, I still own physical silver, which I view as essential wealth insurance in an era of currency debasement. I still own quality mining companies that will do well in any silver bull market, even if it takes longer to develop. I've risked only a small amount on time-sensitive options. This is how you position for high-conviction ideas while managing the reality that markets can be unpredictable. Here's what I need you to understand at a fundamental level. Silver is the most manipulated commodity market in modern finance. The paper price has been suppressed for decades through futures and derivatives that represent far more metal than exists. This manipulation works as long as most contracts settle in cash and physical delivery isn't demanded. But when real-world industrial users and investors demand actual metal and the vaults are empty, the scheme collapses. We're at that inflection point right now. Friday represents the convergence of forces that could break the manipulation and force a price reset to levels that reflect actual scarcity. $300 per ounce is not a random number. It's based on the calculation of what price level is needed to balance industrial consumption, attract recycling, incentivize new production, and satisfy investment demand in a world where the traditional paper pricing mechanism has failed. Every rigorous analysis of silver's true value in a free market arrives at triple-digit prices. The question you have to ask yourself is, are you going to act on this information, or are you going to wait and watch? Waiting for perfect information means waiting until after the move has happened. Waiting for mainstream confirmation means buying at $100 what you could have bought at $25. Taking action based on compelling evidence, while there's still time, is what separates people who build wealth from people who watch others build wealth and wonder why they didn't see it coming. I'm giving you the analysis, the evidence, the timeline, and the exact steps to position yourself. The information is here. The opportunity is in front of you. Now it comes down to your decision and your execution. What are you going to do? Are you going to buy physical silver today? Are you going to add mining stocks to your portfolio? Are you going to take this seriously and position yourself for what could be the trade of the decade? Or are you going to dismiss it, ignore it, and potentially regret it for the rest of your life when you see silver at $150 or $200 or $300? Share this video immediately with everyone you care about. Your friends and family deserve to know what's coming. They deserve the chance to protect and grow their wealth. Post this everywhere. Get the message out. The silver shortage is real, the Friday deadline is approaching, and the price reset is inevitable. The only question is whether people are positioned for it or caught off guard by it. Don't let the people you love be caught off guard. Subscribe to George Vance Live right now and turn on all notifications. I'll be providing daily updates as we approach Friday and as this situation develops. If the squeeze happens as I anticipate, you'll want real-time guidance on managing your positions, when to take profits, and how to navigate the volatility. This channel is your resource for cutting-edge intelligence on precious metals and markets. Make sure you're plugged in. Drop a comment below telling me what you're doing. Are you buying physical? How much are you allocating? What stocks are you buying? Let's build a community of people who understood what was coming and positioned themselves to profit while everyone else was asleep. Share your strategy and learn from others. Friday is coming whether you're ready or not. The price reset is happening whether you believe it or not. Silver at $300 is possible whether you think it's realistic or not. The mathematics don't care about your opinion. The supply and demand fundamentals don't care about your skepticism. The industrial users demanding delivery don't care if you think it's too extreme. The market will do what the market will do, and those who position themselves will capture wealth, while those who hesitated will watch and wish they'd acted. This is George Vance Live, giving you time-sensitive intelligence that could change your life if you have the courage to act on it. Silver is being reset. The paper manipulation is ending. The physical shortage is forcing price discovery. $300 per ounce is the target based on fundamental analysis of what it takes to balance supply and demand. Buy before Friday while you still can. Buy physical metal. Buy mining stocks. Position yourself for generational wealth transfer. The clock is ticking and the opportunity window is measured in hours, not days. Don't let it close while you're still sitting on the sidelines. Act now and thank yourself later. Until next time, stack silver like your financial future depends on it, because it just might.